as the Homebuilder ETF outperforms the S&P 500 significantly, you're getting some news articles that are saying that homebuilder stocks are still kind of cheap. And so, the question that I want to ask in this video is, are they actually that cheap? And so what I'm going to do is I'm going to take a look at some of the names and actually look at the ETF compared to the S&P 500 as a whole. And then I'm going to argue that it may not necessarily be as cheap as you think, but there are other industries right now in this environment that could potentially be holding real value. And so as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now let's dive right into this. So you can see MarketWatch reported that Homebuilder ETF outperforms the S&P 500. However, the industry stocks still look cheap. And so the first question I have is, really? Do they? I mean, probably, but a lot of the value has been taken away, and this is what I'm talking about. So, not a lot of people were talking about home builders a couple of years ago, but this was my #1 portfolio position going into 2023. And notice that, the home builder ETF relative to the S&P has significantly outperformed. Now, I'm not saying that the S&P hasn't done bad. Look at how well the S&P has actually done. It's almost and it actually did cross 15% year to date at one point before coming back. But notice that the home builders are up way much higher, almost double at 30%. Even before this surge, which was recent, still being in that 25% area has been absolutely significant for the home builders. And the fact that I publicly came out last year and said my #1 portfolio position is home builders is just like a good look overall. But it was easy to see the opportunity, and I'm happy that I pivoted so strongly into this space as I did. And so the question was, why was I so bullish on home builders over the last couple of years? And really my thesis, and you can go back into the videos and take a look, but the thesis really was that work from home is becoming more normal, and household formations, and this is the more important part, household formations are running ahead of home building. And so this whole thesis is playing out as expected. And so what do I mean about households formations running ahead of home building? Really, it's hard for people who have lived through the 2008-2009 housing collapse to believe that we actually have an undersupply of housing, because back then we had such a significant oversupply of housing that it pushed down home prices nationally. And so to even think that 10 years later, can you imagine, put yourself back in that 2008-2009 space? For any of you guys who did go through it, that was very like a very traumatic experience, I would say. I still think about it often. And, one of the things that you would think is, if somebody told you, hey, 12 years from now, we're going to have a national housing shortage, or 13 years from now, would you believe them? I don't think you would believe them. And so this is why I think it's hard for people to digest the fact that household formations have run so far ahead of home building that you're now millions of homes short nationally. And part of the reason why the share prices for home builders surged so much recently is because sales of newly built homes in May in the US actually surged. And really it's because not a lot of people are selling their current homes. People aren't moving. And so if you want to buy a house, there's just a huge shortage of homes being sold on the market. And so you have to buy new homes. Now, this was an interesting part. The main focus of my thesis was that it would be the South and the East, like basically the Southeast area. So I'm talking like Texas, Florida, the Carolinas, etc., that would see the highest surge. What I found was a surprise is that the Northeast and West actually led the strength of new home sales across the nation recently. So that was pretty interesting. And, it's something to pay attention to as, we continue to move forward here. And this is what I mean about the housing market being short. So I tried to find a recent article talking about this. And so this was as early as March of this year. So, CNN Business reports that the housing market is short 6.5 million homes. And really, it's just a case of the story has not changed. The US is still not building enough homes to account for the number of people setting up their own households. And so in the decade between 2012 and 2022, 15.6 million households were formed. And during that same period, only 11.9 million houses were complete. So you can see that there's a huge imbalance there. And so what needs to be done to close the gap? Well, if building and household formation were to continue at their current pace, the gap would never close. In order for you to close the gap, you have to triple housing starts to keep up with the demand to close this gap in 3 to 4 years. So, this is a serious bull case for the housing industry. But like I said, part of those valuations are now expecting more of a bull case. And so you may not necessarily see the share prices continue to surge for the housing builders as you did early this year. And this really comes down to, or let me just speak to this quickly, then I'll talk about my next point. So I think the larger issue is that, you have a zoning issue. You have a lot of NIMBYs, not in my backyard, when it comes to sort of like multifamily, but also new developments. And so, just getting access to build homes is an issue, which makes home building expensive. And so it's not just materials, but it's also just getting access to land. But the bigger issue is, and it's something that I mentioned over and over again over the past couple of years, as I was building up my position in the home builders, it's not whether or not you expect a good market or a bad market in the industry. It's how much of those risks or the potential risks or potential good news stories, I guess, are reflected in the share price. And what you were having, or what you were seeing in many of these securities, is that they were trading at 4 or 5 times earnings. And so what was being reflected there was that a lot of the bad news was already reflected in the share price. And so one of the things that I said, especially for the name like a Dream Finders, which was trading at certain points at around 4.5 times earnings, is what happens if their earnings fall off a cliff? Well, worst case scenario, you're looking at a 9 times EPS stock. So even if their earnings fell off a cliff, it's still a cheap name. And so it just reflected the fact that there was a lot of risk that was taken out of the name because the share price was down. Now we're in an environment where it's a really good news story for these home builders. However, as their buying surges for these home builders, how much of that future value is already priced into the securities? You don't have an $8 stock anymore as it relates to Dreamfinders securities. You have something closer to $28. So how much of that is reflected in the share price? And so it just comes down to how much risk has been priced into the security, or how much good news has been priced into the security. That's all that matters. And so that's why these opportunities were easy to see back earlier on when the share prices were so much lower. And I'm not as much of a bull on the home builders as I am now. Notice that while everyone is, and I said this before, while everyone was investing in tech in 2021 and 2022, I was probably the only YouTuber out here who was really, really bullish on home builders. I think it was easy to see that the segment was going to massively outperform, and patience actually won the day. You know what's actually funny? As I was releasing those videos on home builders, people would come back 6 months later and be like, oh, this video didn't age well. And it's like, 6 months is not enough time for a thesis to play out. Sometimes theses take multi-years to play out. And so now it seems like the home builders seem like a great idea, but I actually went back and replied to some of those comments thereafter, and I said, I wasn't mean about it, but I was just like, sometimes it pays to wait, and it definitely paid to wait. But now I do believe that home builders are way down on the list, which means that their share price as a percentage of intrinsic value is not as low. This is ranked on share price as a percentage of intrinsic value. So the lower down the list you go, the higher the percentage will be. You'll get to 100, 200%, etc., meaning that the share price could potentially be twice the intrinsic value. And so the lower the name is, the less cheap I think it is on a price to intrinsic value basis. And so this is the Patreon. This is the tracker that the Patreons get access to at that lower tier. And what you can actually do is when you subscribe, you can click into these tickers. So you see Alibaba here, but you can also click into Dreamfinder Homes or LGI Homes. and you can get to their individual models to see sort of like how I built it out, and ask yourself if that's how you would model it or if you would model it a different way. And you can see Dreamfinders was puddling along for a little while. It came up to, you know, around 12.5, and then it, you know, went back down under $10 per share in January, and then of course now we had the surge. So it's like, it's, you know, it was a big position in my portfolio. It was the largest position that I had in any home builder, and you can see that it's up over 100% over the last year. So that was very nice to see. It's nice to get wins in the portfolio. And of course, the OGs of the channel would have noticed that, you know, when LGI Homes, or when I first started the channel, one of the main stocks that I spoke about, or the early stocks that I spoke about, was LGI Homes. Now, I started the channel around here, and this is really when I started getting into LGI Homes. So what I was surprised and took me back is how quickly the stock went from sub $100 per share all the way up to nearing $200 per share. And that actually took me by surprise. So I started selling it right here in 2021, and I never really got back into it. And so I actually did miss this run up because I was just, I became a little bit too picky, I would say, for the second run. And, you know, I knew it was relatively cheap, but I was getting more and more selective on the securities that I was buying. And partly the reason for that was because over, I would say from, 2021 into 2023, like this whole time period, I think what I started to do is I started becoming a more conservative investor as a whole. And so the opportunity had to really, really be a fantastic opportunity for me to invest in it. And, you know, LGI Homes was a good opportunity. It just wasn't fantastic. And so that's why I missed out on the second run. And I'm totally comfortable with that. And so the question is, would I invest in home builders now? I don't think so. I think the industry that I'm more focusing on now is a different opportunity. So, you know, since March, we've seen a huge decline in regional banks. And this is what I mean. Like, there's always an opportunity. And, you know, I've been aggressively deploying capital into the regional banking space. I find, you know, sporadic opportunities. And I'm seeing more and more opportunities in sort of like specialty finance areas that I've been investigating. And so, you know, we've already seen a bit of a run. That's for sure, but it's not really been anything material. We actually saw a decline recently as well. And so I think there's a lot of opportunity here, but the question is, you know, how do you find the opportunity? Because banks are so difficult to invest in. And I also recommend that most people who are new to investing or novices of investing should not focus on regional banks ever. Just don't focus on banks or insurance companies ever, because a lot of the risk for banks and insurance companies you cannot see in their financial statements and in their disclosures. You just have to know things. And so it is a tougher place, but because it's a tougher place, I'm noticing that value investors are staying far away from it, which is great, because the only people who are really seeing value here and going after that value are people who focus specifically on banks. So you're seeing former banking analysts talk about this stuff, and former people who were on the buy side who specifically just invested in banks or covered banks, who are coming out and talking about specific opportunities that they didn't think would come about. And so it's just been a very interesting place. But the other thing is, you know, when it comes to value investing, you're always going to be lonely. The best opportunities are even those where the value investors are not looking. So even value investors were not looking in the housing space a couple of years ago, and they're definitely not looking in the regional banking space now. And so some of these opportunities are available in plain sight, and everybody knows they're there, and they'll still avoid them. And by now, many of you guys know me. I don't avoid these types of opportunities. And so, you know, what I've done is I've actually prepared a comps schedule that compares 10 key performance indicators across 63 national and regional banks. I also sort the banks based on their price to book, so price to tangible book. So you can really use this schedule to potentially spot many undervalued opportunities, like I did. Actually, I used the schedule myself, and some names will be cheap for a reason. So don't just buy names that are at the top of the list, like up this way, of course. And some, you know, so some names will be cheap for a reason, but others not so much. And so I found some interesting opportunities. You know, I spoke about Bank Ozic on this channel before. I really like that name. I also like US Bancorp. Those are two names that I included in my portfolio. Other names that I would probably incorporate over time would probably be M&T Bank. That's something that would make it into my portfolio. This one was very interesting. I have an interesting note on this one. So if you guys have access to the comp schedule, take a look at the note on this one, and it really speaks to the differences in strategy and how a riskier strategy could really impact the business. You know, there's a reason why they're down almost 40% when some of the other banks are not down as much. I mean, there's other banks that are down more than that, but it's a very interesting thing because this was a name that value investors really loved over many years. And I think some people got caught in the value trap for this particular name when the names went down anyway. So very interesting. And that's why the comps help, because it sort of shows you what banks outperform. But the other thing about the comps is that just because a bank is outperforming at the comps level doesn't necessarily mean that it's a good bank. You still have to understand why are they so good in comparison to their peers. What is their strategy? What makes them riskier? What makes them safer? What is their sustainable competitive advantage? And, you know, those questions you can't answer with a comp schedule, but at least a comp schedule points you into the direction of particular names to research. And so you can get access to all the models at the lower tier. And then on the higher tier, that's where the comp schedule is, but you also get live courses or just courses now. I'm not releasing them live anymore because I find that a lot of people can't come to the live courses. So I just record them and I just put them out there for everyone to access whenever they can. And then we also have monthly live calls where I do a brand new presentation every month into what opportunities I'm seeing in the market. And so let me know what you guys think about the housing space and what you guys think of the regional banking space. Also, you know, I found it very fascinating how much the corporate world has changed as a result of the whole Bud Light situation. And so I recently put out a video on that. And if you missed that video, you can get access to it right here.